You know, it's funny. You walk down the aisles of a grocery store and there is this powerful, almost subconscious expectation of like permanence.
Oh yeah, absolutely. It feels like architecture.
Exactly. You go to the cereal aisle and the boxes are just lined up perfectly. Or the coffee cup stacked at your local cafe. You just grab what you need without a second thought. You buy the cereal, you eat it, you recycle the box. And it all feels so simple and clean, right?
Yeah, very neat.
But behind that neat, predictable cardboard is an $8.6 billion industrial titan called Graphic Packaging Holding Company, ticker symbol GPK.
Right, a total behemoth.
And right now, their financial foundation is actually cracking under the weight of a $1.6 billion factory blowout, not to mention a massive inventory clip.
Yeah, it's messy.
So we are opening the books today on this Talk Tickers edition of The Deep Dive. Our mission is to translate all this Wall Street jargon into plain English and break down their Q4 2025 earnings call. Because this neat, predictable grocery aisle is actually the front line of a very chaotic, high-stakes corporate transformation.
It really is. I mean, it is the absolute definition of a complex industrial pivot. And it's happening right under our noses.
Yeah.
Like when you hold a paper cup or when you buy fresh produce in one of those little paperboard trays.
All right, the produce trays.
Yeah, or grab literally any private label grocery item. There's a very high probability you are interacting with graphic packaging's supply chain.
They're everywhere.
They are. They aren't some niche player. They are the plumbing of the consumer goods world.
Yeah.
But their Q4 2025 earnings call reveals a giant that is basically choking on its own aggressive expansion.
Okay, so let's pull up the tape on those earnings. I want to start with the headline numbers because the dissonance between the top line revenue and the bottom line reality is just jarring.
It's a huge disconnect.
Right. So for the fourth quarter of 2025, GPK reported net sales of $2.1 billion, which is basically flat year over year. And if you zoom out to the full year, 2025 net sales were $8.6 billion. That's down about 2% from the previous year. Now, a 2% drop on $8.5 billion isn't like a death sentence on its own.
No, it's a rounding error for them, really.
Right. But what happens when we move down the income statement to the actual profitability?
Yeah.
Because that's where the story changes.
That is where the structural cracks become impossible to ignore. So Wall Street typically measures this using adjusted EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization.
Exactly. It's designed to strip away the accounting noise and to show you the core operational profitability of making and selling boxes. And for the full year, their adjusted EBITDA came in at approximately $1.4 billion.
Okay. I am going to push back right there.
Go for it.
Because if I am an everyday investor looking at a stock screener and I see $1.4 billion in core operating profit, I think, wow, that is a mountain of cash. Like, what's the problem?
It sounds great on paper.
Yeah. But obviously that number is hiding a lot of pain. So where is that profit actually bleeding out?
The bleeding is happening in the margins, driven by forces that they're really struggling to control right now. So that 1.4 billion figure is actually deeply impaired.
How so?
Well, during the year, they faced $150 million in pure commodity and operating cost inflation.
Ouch.
Yeah. The raw materials,
Yeah.
energy to run the mills, the logistics to move those massive paper rolls, all of it spiked.
So it just costs more to run the business?
Exactly. But what's more concerning is the second headwind. They took a combined $174 million hit strictly from a drop in prices and volumes.
Wait, so they are getting hit for both sides?
Yes. A total squeeze.
The inputs to make the cardboard are more expensive, but they can't pass those costs on to their customers because demand is falling, so they're forced to actually lower prices just to keep the machines running.
Yeah, it is a brutal margin squeeze. It is the worst case scenario for a heavy manufacturer.
Because you can't just pause everything right.
Right. You have massive fixed costs that do not care if your volume drops. And that brings us to the adjusted earnings per share, or EPS, for the full year, which landed at $1.80.
$1.80, which again, in a vacuum, if you own a share, knowing the company generated $1.80 in profit feels okay.
Sure, it's positive.
But there's a massive anchor tied to that EPS, and it's the number that I know had analysts sweating on the earnings call, the net leverage ratio.
Oh yeah, the leverage.
It is sitting at an incredibly uncomfortable 3.8 times.
Yeah, that's high.
If you are holding this stock right now, listening to this 3.8x leverage should make you very nervous. Can you break down the mechanics of why that specific ratio is a 5-alarm fire in the manufacturing sector?
Absolutely. So net leverage is essentially the ratio of a company's total debt to its core operational earnings, EBITDA number we talked about.
Right.
A ratio of 3.8 times means that if Graphic Packaging took every single dollar of its operational profit and used it for nothing but paying down debt.
Like zero spending on anything else.
Exactly. No dividends, no factory maintenance, no new hires. It would take them almost 4 full years to wipe the slate clean.
That's insane.
And in the capital-intensive world of heavy manufacturing, a healthy, flexible company usually targets a leverage ratio closer to 2 or maybe 2.5 times.
Because at 3.8 times, you have zero room for error. Right.
Exactly.
Like if the economy tips into a recession and the massive consumer brands order 10% fewer boxes, your earnings drop. But your interest payments on that mountain of debt stay exactly the same.
And it becomes this vicious cycle. The cost of that debt starts to dictate how you run the business. This ties into a crucial financial concept called the weighted average cost of capital, or WACC.
Okay, let's unpack WACC.
So when your leverage pushes up toward 4 times, credit rating agencies get really nervous.
Naturally.
And if they downgrade your debt from investment grade down to high yield, which is just a polite Wall Street term for junk bonds, the interest rates on your loans spike.
Right, because you're a higher risk.
Exactly. So your WACC goes up. Suddenly, these new projects that used to be profitable are no longer viable because the cost of borrowing the money to fund them is just too high. You become completely paralyzed.
So we have an $8.6 billion company that is essentially a hostage to its own balance sheet.
That's a great way to put it.
They are bringing in massive revenue, but the margin squeeze and the debt burden mean they are structurally fragile.
Very fragile.
So to understand how they got into this trap, we need to look at what the new CEO, Robert Reeprook, uncovered when he took the job. Because he was barely 30 days into his tenure when this earnings call took place.
Yeah, talk about a rough first month.
Imagine walking into the corner office, asking for the ledgers, and realizing the foundation is sinking. Let's look at the first massive crater he found, the Waco, Texas greenfield facility.
Oh, the Waco facility. It is a textbook example of a CapEx, or a capital expenditure blowout. Graphic Packaging didn't just upgrade an old factory, they decided to build a greenfield plant.
I want to make sure we define that clearly for everyone listening. Greenfield means literally starting with an empty green field.
Yes, literal dirt.
You aren't buying an old car factory and retrofitting it to make paper. You have to run the water lines, build the power substations, secure the environmental permits, and pour every single ounce of concrete before you even install a machine.
It takes years.
It is incredibly risky compared to a brownfield project where the infrastructure already exists.
It's the highest risk maneuver in heavy industry, frankly. And the risk materialized violently here.
How bad was it?
Well, the initial budget targets for company-wide capital spending were aggressively overshot, driven almost entirely by Waco. The current estimated total spend for this single facility is a staggering $1.67 billion.
$1.67 billion for one paperboard plant. Where did all that cash even come from?
That came from the debt we were just talking about.
So, of course.
They borrowed heavily to fund the construction. And the hidden poison in that $1.67 billion figure is something called capitalized interest.
Capitalized interest. Okay.
They have roughly $80 million wrapped up purely in the cost of borrowing the money to build the plant.
Wait, explain how capitalized interest works, because normally, interest is just an expense that hits your income statement immediately, right?
Normally, yes.
How does it get wrapped up into the cost of the factory itself?
So in corporate accounting, if you take out a massive loan to build a long-term asset like a factory, and it takes, say, 3 years to build, you don't have to report those interest payments as a pure loss on your income statement during that construction phase.
Really?
Yeah. The accounting rules allow you to add those interest payments to the total recognized value of the building on your balance sheet. You are capitalizing the interest.
That feels like a dangerous accounting illusion.
It kind of is.
I mean, you are paying cash out the door to the bank, but on paper, you are claiming your factory is just becoming more valuable.
Exactly. It masks the immediate pain. It makes the company look more profitable in the short term because that interest expense is hidden in the asset column. But the cash is still gone. And eventually, once the factory turns on, you have to start depreciating that massively inflated asset value over time, which just drags down your future earnings.
So the bill always comes due.
Always. And by the end of 2025, Graphic Packaging had already spent $1.58 billion of that total Waco budget.
Wow.
So the cash is out the door, the debt is on the books, and the leverage is sitting at that 3.8x.
So it's not a temporary speed bump. It's a structural engineering failure of their capital allocation.
That's exactly what it is.
But building an expensive factory is only half the problem, right? Even if the factory was free, they have a massive issue with what is sitting inside their warehouses. The second crisis the new CEO found was the inventory glut.
Oh, the inventory. Their inventory levels have ballooned to 20% of their total sales.
20%.
Yeah.
If they sell $8.6 billion a year, they are sitting on well over $1.5 billion of cardboard and paper just gathering dust.
Literally.
How does a logistics company miscalculate demand that badly?
It is a combination of hubris and a total misread of the macroeconomic environment. Management claimed they needed to build up buffer inventory to prepare for the startup of the new Waco plant.
Okay, the logic being what exactly?
The idea is that when you switch production lines from old facilities to the new one, you need a stockpile so your customers don't experience a disruption.
That makes sense on paper.
It does. But simultaneously, market demand softened far more than they anticipated, and they kept the machines running at full capacity, assuming the orders would just materialize eventually.
But they didn't.
He didn't.
It's the ultimate working capital trap. Cash is the lifeblood of a business, and right now, Graphic Packaging has over $1 billion of cash trapped in the physical form of unsold cardboard.
You can't pay down debt with cardboard.
Exactly. You can't use cardboard to pay the interest on your debt. You can't use it to pay dividends, and the longer it sits there, the more it costs to store it and insure it and manage it.
And that leads directly to the third crisis, which compounds the inventory problem exponentially. The pricing environment. The broader market is currently suffering from a significant overcapacity in commodity bleached paperboard.
But let's dig into bleached paperboard for a second, because this isn't the brown corrugated cardboard of an Amazon shipping box.
No, totally different beast.
This is the pristine white, high-quality board you see used for like premium cosmetics or high-end frozen food packaging or pharmaceutical boxes. It requires a more intensive chemical bleaching process, which makes it a lot more expensive to produce.
And historically, it commands a premium margin because of that. But right now, the market is flooded with supply. And when you are selling a true commodity, meaning your bleached paperboard is fundamentally identical to your competitor's bleached paperboard, you have zero pricing power if there is a glut.
Right, because it's all the same.
If Graphic Packaging tries to maintain a high price, massive buyers like Procter & Gamble or PepsiCo will simply buy from a competitor who is desperate to offload their own excess inventory.
The power dynamic completely shifts to the buyer.
100%.
If you are P&G, you know the paper mills are choking on inventory. You know their leverage is high. You walk into the negotiation and dictate terms.
Yep.
You say, we will buy your paperboard, but we are paying 10% less than last year. And GPK just has to accept it because keeping the machines running at a lower margin is perceived as better than shutting them down.
But that perception is exactly what the new CEO is challenging.
Really?
Yeah. Robert Reeprook looked at the $1.67 billion factory, the 20% inventory glut, and the collapsing commodity pricing. And he realized the old playbook was driving the company into a ditch.
So what's the fix?
He has to administer immediate painful medicine to fix the balance sheet.
And his prescription is what they politely refer to on the earnings call as production curtailments.
Such a gentle word for such a violent action.
Right. The goal is to slash 200,000 tons of inventory. I want to spend some time on what this actually looks like in practice, because curtailment sounds like a gentle corporate adjustment, like a slight tuning of a dial.
It is anything but gentle. A production curtailment means they are physically powering down massive, multi-million-dollar manufacturing lines.
Wow.
These mills are designed to run 24 hours a day, 7 days a week, 365 days a year.
They never turn off?
Never. The entire economic model of a paper mill relies on immense throughput to offset the massive fixed costs of the facility.
So when you turn off a machine, what happens?
Well, the variable costs like raw timber and electricity stop.
Okay.
But the fixed costs, the property taxes, the insurance, the salaries of the core maintenance staff, and crucially, the interest payments on the debt used to build the machine. Those costs keep demanding cash every single day.
It's a terrifying decision for a plant manager. You are actively choosing to lose money on a daily operational basis to solve a balance sheet crisis.
Yes, it goes against every instinct they have.
I think of it like an extreme home renovation gone wrong. It's as if you decided to build a massive state-of-the-art kitchen extension. That's the Waco facility.
Okay, I like this analogy.
The contractor promised it would cost $100,000, but it spiraled to $250,000. You put it all on high-interest credit cards. Meanwhile, you were so distracted fighting with the contractor that you accidentally set up a recurring delivery for paper towels. And now you have 2 entire rooms of your house filled floor to ceiling with paper towels.
That captures the dual nature of the crisis perfectly. You have a long-term capital liability and a short-term working capital trap.
Right. And now you check your bank account and you have no cash left to pay the credit card minimums.
Yeah.
So what do? You have to make a painful, unnatural choice. You completely stop buying groceries. You stop going to restaurants. You force yourself and your family to eat only what is left in the pantry. And you try to sell the hoarded paper towels to your neighbors at a discount just to scrape together enough cash to pay the credit card bill.
Yep.
You look impoverished. Your daily quality of life plummets. But it is the literal only mathematical way to avoid bankruptcy.
The daily quality of life plummeting in your analogy is exactly what the 2026 financial guidance represents for graphic packaging.
It's the diet.
It's a starvation diet. CEO Reeprook is forcing the company to eat from the pantry. He is prioritizing raw cash generation over the appearance of profitability.
So let's look at the numbers of that 2026 guidance, because if you don't understand the strategy we just outlined, the projections look like the company is straight up collapsing.
They really do.
In 2025, they delivered an adjusted EPS of $1.80. For 2026, management is guiding for an adjusted EPS range of 75 cents to $1.15.
The midpoint of that guidance is under $1.
Wow.
They're essentially telling Wall Street that their earnings per share will be cut in half next year.
In almost any other scenario, guiding your earnings down by 50% triggers a massive sell-off. Retail investors panic, institutional algorithms dump the stock. Why isn't the sky falling here?
Because the plunging EPS is a symptom of the cure.
Okay.
The 2026 adjusted EBITDA is guided between $1.25 billion and $1.5 billion on a reported basis. But that number is being artificially depressed in the first half of the year because of those production curtailments.
Right, turning off the machines.
Exactly. Turning off the machines and absorbing all those fixed costs without producing new goods to sell is going to generate a direct $85 million negative impact on their earnings.
They're choosing to take an $85 million hit to the income statement to fix the balance sheet.
Yes. And here's where the financial pivot becomes brilliant, albeit painful. While earnings and EBITDA are dropping their 2026 crotcha, adjusted free cash flow is expected to experience a massive spike.
How massive?
Landing between $700 million and $800 million.
I want to make sure every retail investor listening absorbs this point, because we are relentlessly conditioned by financial media to only care about EPS.
Oh, conflict.
Earnings per share is treated like the ultimate scoreboard. But EPS is just an accounting metric. It includes all sorts of non-cash adjustments, depreciation, and amortizations.
Right. It's not real cash in your hand.
Exactly. Free cash flow is the actual tangible cash a company deposits in the bank at the end of the quarter after paying to maintain its hard assets. In a turnaround situation, EPS is vanity. Free cash flow is sanity.
That is the defining theme of Reeprook's strategy. Vanity versus sanity.
I love that.
So how do you generate $800 million in free cash flow when your earnings are getting cut in half? It comes down to a drastic discipline shift in capital allocation.
Walk us through it.
First, the $1.67 billion Waco nightmare is finally wrapping up.
Thank goodness.
The heavy lifting is done. So management is slashing their company-wide capital spending down to roughly $450 million for the year.
What?
That is hundreds of millions of dollars that are suddenly no longer flying out the door to contractors.
So the kitchen extension is finished, so the bleeding stops there.
Yes. Second, the inventory drawdown we discussed. By turning off the machines and fulfilling customer orders using the 20% inventory hoard sitting in the warehouse, they were collecting cash from clients without having to spend cash on raw timber chemicals or electricity.
They're just shipping what they already made.
Exactly. They're converting trapped working capital back into liquid cash.
So the accounting profit, the EPS, looks terrible because the factories are running inefficiently, carrying dead fixed costs. But the actual bank account is swelling because they slash construction expenses and are liquidating $1 billion worth of hoarded product.
That's the magic trick.
The mechanism is fascinating. But what is the ultimate goal here? What are they going to do with that $800 million mountain of cash?
They are going to attack the single biggest threat to the company's survival: the debt.
Nice.
They have explicitly prioritized an expected $500 million in debt paydown for 2026.
$500 million wiped off the balance sheet in 12 months. If they pull that off, it radically changes the risk profile of the stock. Oh, absolutely.
It pulls that terrifying 3.8x leverage ratio down out of the danger zone.
It does more than just lower the ratio. It begins to repair their relationship with the credit markets. By proving they have the discipline to sacrifice short-term optics for long-term solvency, they build credibility.
Because Wall Street loves a disciplined capital allocator.
They do. And management stated clearly that their North Star is achieving an investment-grade credit rating by 2030.
And we talked about why that matters earlier. An investment-grade rating drastically lowers their weighted average cost of capital. It means when they eventually need to borrow money again to upgrade a facility or buy a smaller competitor, the banks will charge them significantly less interest.
Exactly.
Lower interest expenses mean structurally higher free cash flow for the next decade.
To ensure this actually happens and isn't just an empty promise on an earnings call, the new CEO has fundamentally altered the corporate structure. He instituted a dedicated transformation office.
Transformation office. Sounds intense. Led by a newly appointed chief transformation officer, whose sole mandate is to drive zero-based budgeting across the entire organization.
Okay, let's deep dive into zero-based budgeting, because it is one of those corporate buzzwords that sounds incredibly dry. But in practice, it is a cultural bloodbath for middle management.
Oh, it's terrifying if you're a manager.
Right. In a traditional corporate environment, a department head looks at last year's budget. Let's say they spent $5 million on logistics software, and they ask for a 5% increase for inflation.
Standard operating procedure.
They get $5.25 million, and nobody questions the original baseline. The fat just becomes institutionalized.
Right. But zero-based budgeting violently disrupts that inertia. The baseline is set to zero every single year.
Wow.
That department head doesn't get to ask for a 5% increase. They have to build a ground-up business case justifying why they need to spend a single dollar on logistics software in the first place.
Every year.
Every year.
Yeah.
Every contract, every software license, every travel expense must be defended as if it's a brand new initiative.
That sounds exhausting.
It forces the organization to constantly evaluate its own efficiency, stripping out legacy costs that no longer serve the core mission.
It is a ruthless, exhausting way to run a company, but it is exactly what you need when you are choking on debt and bloated inventory.
Precisely.
And this hyper-disciplined approach makes perfect sense when you look at Robert Reeprook's background. He didn't come up through the ranks of the paper mills. He spent 25 years as an executive leading global consumer brands at Procter & Gamble, Kimberly-Clark, and PepsiCo.
That background is the skeleton key to understanding this entire turnaround. For 25 years, Reeprook was the customer of companies like Graphic Packaging. He was the one negotiating on behalf of PepsiCo, demanding lower prices, tighter supply chains, and zero defects. He intimately understands the pain points of the massive consumer packaged goods companies, the CPGs.
He knows what the buyer wants because he was the buyer.
Exactly.
He knows the CTGs don't care about Graphic Packaging's internal EPS targets. They care about reliable, low-cost packaging that protects their own margins.
Mm-hmm. So he brings a ruthless customer-centric operational discipline to a paperboard company that frankly seemed far more interested in aggressively expanding its own footprint than optimizing its balance sheet.
Having the customer take over the factory floor changes everything. He looks at the bloated inventory not as a buffer, but as a glaring inefficiency that drives up costs.
Right.
He looks at the Waco plant not as a monument to growth, but as a dangerous misallocation of capital that must be immediately reined in.
So we have a new sheriff in town armed with zero-based budgeting, turning off machines, liquidating inventory, and funneling every spare dollar into debt reduction. The narrative is incredibly compelling.
It's a great story.
But narratives don't always translate into stock performance. I need you to synthesize all these massive moving parts into actionable advice. For the Talk Tickers audience, what is the ultimate bottom line on GPK?
The verdict requires a split time frame. You cannot view this stock monolithically. I am distinctly bearish on the near-term momentum, but I am cautiously bullish on the long-term structural turnaround. Okay, break that down for the retail investor who is listening to this right now, holding shares, watching the stock ticker fluctuate. What should their expectation be for the next, say, 6 months?
If you are holding the stock today, you must brace for extreme visceral volatility. specifically in the first and second quarters of 2026.
Why specifically then?
The executive team was exceptionally transparent about this. The first half of the year is going to be incredibly ugly on paper. That is when the heaviest, most painful production curtailments will hit.
So the numbers will just look awful.
Terrible. The factories will be running below capacity. The earnings per share will be shockingly low. The financial media headlines will likely blare that GPK is missing earnings estimates and losing momentum.
So the immediate emotional reaction for a retail investor will be to panic and sell.
Precisely the reaction you must fight against. If you understand the thesis, you understand that the low EPS is intentional.
It's a feature, not a bug.
Right. Do not stare at the earnings. Instead, pull up the cash flow statement every quarter. Watch the debt level. If the inventory is shrinking and they are successfully funneling hundreds of millions of dollars toward that $500 million debt paydown target, the medicine is working. The turnaround is on track, regardless of how terrifying the income statement looks.
You are buying into the 2027 and 2028 repaired balance sheet, not the 2026 income statement.
Exactly.
But what if I don't own it yet? What if I'm on the sidelines listening to this thinking it sounds like a brilliant deep value turnaround play? Should I buy in now before the market realizes the cash flow potential?
If you are considering initiating a new position, graphic packaging is the ultimate show-me story.
A show-me story. I love that term. Don't buy the promise, wait for the proof.
The CEO has a phenomenal pedigree, and his zero-based budgeting plan is theoretically perfect. But execution in heavy industry is notoriously difficult.
Things break.
Always. Guys waiting on the sidelines to see if they can actually deliver on that $700 million to $800 million free cash flow target in the first 2 quarters. Wait for irrefutable hard data that the $500 million debt paydown is actually happening before putting your capital at risk.
Because the risk is that the production curtailments damage their relationships with key customers.
That's the huge risk.
Like if you shut down a line and suddenly you can't fulfill an emergency order for Procter & Gamble, P&G might just shift their massive contract to a competitor permanently.
Exactly. Let management prove they can endure the surgical pain of this restructuring without accidentally amputating their core customer base.
That's a great image.
The stock might be slightly more expensive once that proof is established, but the risk profile will be exponentially lower.
It is a phenomenal breakdown of a classic industrial turnaround. The discipline required to execute this is staggering. But before we wrap up this deep dive, there's one more thread from the earnings call that I really cannot let go of.
Oh, I know where you're going with this.
It was mentioned almost in passing by the CEO, but it points to a macroeconomic tectonic shift that I believe will fundamentally alter the future of companies exactly like graphic packaging.
You are referring to the commentary on changing consumer dynamics and the rise of GLP-1 medications.
Yes. The CEO explicitly highlighted the challenges and opportunities operating in a world shaped by GLP-1s and the aggressive evolution of private label brands. Now, for anyone who hasn't been following the pharmaceutical sector, GLP-1s are the revolutionary class of weight loss and diabetes drugs.
Names like Ozempic, Wegovy, Mounjaro.
Right. They're literally altering the biological appetite of millions of consumers.
It is a stunning example of how interconnected the global economy truly is. On the surface, a breakthrough in injectable medicine seems entirely divorced from the industrial mechanics of a paperboard mill in Texas.
Completely unrelated, right?
But if you follow the causal chain, the impact is massive.
Follow that chain for us. How does a medical injection literally force a multi-billion-dollar packaging company to rethink its entire business model?
It starts with the consumer. Clinical data and consumer behavior studies are consistently showing that individuals on GLP-1 medications consume significantly fewer calories. Their overall food intake drops, and more importantly, their consumption of highly processed, high-margin snack foods and sugary beverages plummets. They simply aren't eating as much.
Which means the massive consumer packaged goods companies, the PepsiCos, the Kraft Heinzes, the Mondeleses of the world, are suddenly facing a structural, permanent decline in the volume of food they're selling to a massive demographic.
And when a CPG titan faces declining volume, their immediate reaction is to protect their profit margins.
Naturally.
If they're selling fewer units of product, they must ruthlessly cut the cost of producing each unit. And packaging is one of their largest variable costs. They turn to their suppliers, companies like Graphic Packaging, and they demand radical changes.
They demand smaller boxes because the portions are shrinking. They demand simpler packaging to save on printing and folding costs. And they engage in what the industry calls SKU rationalization.
SKU rationalization is critical here.
Let's explain that.
So instead of offering a snack in 6 different sizes, a snack pack, a regular box, a family size, a party size, to appeal to every possible consumer impulse, the CPG company cuts it down to just 2 core sizes.
Which destroys the old business model for the packaging companies. Graphic packaging used to make high margins by setting up complex, customized manufacturing runs for all those different SKUs.
Right, setting up the line for a new box shape takes time and money.
If the CPGs simplify their demands, the packaging becomes far more commoditized.
Furthermore, as inflation pinches the everyday consumer, we are seeing a massive flight to private label brands.
The generous store brands like Costco's Kirkland or Target's Up and Up.
Yes, private label brands historically prioritize rock-bottom packaging costs over flashy, premium, expensive cardboard designs.
It's an incredible convergence of forces. A pharmaceutical innovation shrinks the consumer's waistline. Inflation shrinks the consumer's wallet. The massive food brands panic over volume and demand cheaper, simpler boxes.
It all rolls downhill.
And all of that pressure rolls down the hill, crashing directly into the balance sheet of Graphic Packaging Holding Company, forcing a new CEO to implement zero-based budgeting and turn off multi-million-dollar machines just to survive.
It proves that no company operates in a silo. A macro trend in healthcare can and will force an industrial manufacturer in the heartland to completely tear down and rebuild its capital strategy.
And that right there is exactly why we do this. That is why we refuse to just read the flat revenue headlines on Yahoo Finance and call it a day.
There's always a deeper story.
The financial world is endlessly complex, deeply interconnected, and full of hidden narratives. If you aren't paying attention to the details, the debt leverage, the greenfield blowouts, the cash flow pivots, and the macro trends, you are just staring blankly at a cardboard box in the cereal aisle, completely missing the multi-billion-dollar drama unfolding right in front of you.
It requires a constant willingness to look past the obvious and really interrogate the underlying mechanics.
Thank you all for joining us on this incredibly detailed Talk Tickers edition of The Deep Dive. Your homework is clear. Keep digging into your portfolios, relentlessly question the consensus narratives, and always look for the free cash flow, not just the vanity earnings.
Watch the cash flow.
You are now officially up to speed on the chaotic, fascinating turnaround of Graphic Packaging Holding Company. We will catch you next time as we continue to sift through the noise and find the signal. Have a great day, everyone.